Sorry, can anybody confirm me that can they hear me? Because I had a message that people can't hear me. Okay, good. Cool. So I will start over. So welcome to this week's webinar. This is Sam, and the agenda for today's webinar is that I'll be covering on G3 economies, which include Eurozone, US, and Japan, and then my colleague Richard will be talking about and giving his analysis on the hospitality sector. To start with, the first thing first, week ahead, and so we have kind of a heavy or important uh, data coming out from US this week that includes pending home sales, consumer confidence, and non-farm payroll. Usually non-farm payroll comes out on Friday, but due to a public holiday uh, in, in US, the data will be coming out on Thursday. There's few important data from the Euro side and Japan side as well. That includes the inflation CPI from Euro side, and then from Japan, the one of the more important Tenkan large manufacturers index and the non-manufacturing index. Few more from China as well. Okay, so the most important thing to start this presentation is about the Greece. Uh, few things, few happenings that's going around since the weekend. Um, ECB has decided to stop the emergency fundings through their ELA program, so they won't. Greece might not get any fund from the ECB. They have also rejected the extension of the bailout of their debt, and one big chunk of their debt, which is due tomorrow, of $1.7 billion to IMF, has been rejected. So they will have to pay $1.7 billion tomorrow, or else they would default. On the Greece side, they have decided to have a referendum on 5th of July to 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 see whether they should go with the terms of austerity that the ECB and the Troika has given it to them as an option. And meanwhile, in Greece, they have started to put capital controls in terms of that the banks will be closed from today until the referendum, so next 6 days, and then the stock market will be closed as well. So this is all what is happening, and what has happened is that it has increased the volatility not only on the Greece side, not only on the Europe, but the entire global market. And if you look into the U.S. futures market right now, it's already down 1.5 or 6%. So what does the entire thing means for us? We believe we believe that the Greece exit is a scenario that all parties, whether it's the Europe, the or IMF, or the Greece themselves, want to avoid. Uh, but assuming if the Greek exit occurs, there could be some serious implications to that. Uh, for Greece themselves, they have already been cut off from the emergency funding and in the bailout program from the Troika, which includes ECB, EU, and IMF. And so what it means is that there will be a huge financial stress on them in the form of bank runs, and that is the reason we know that they have started this capital, like I mentioned, they have started this capital control to avoid the bank run. For Europe, even without a complete breakdown of the Europe for the entire euro, Greece exit might, for a short-term basis, might be something that will bring volatility, not only in the Europe side but on the global side as well. And why the global side will be affected is because the European Union itself constitutes about 1/5 of the global trade. So anything that occurs to the euro will definitely have contagion effect to the rest of the world as well. We would still say we would still maintain uh, our view that clients should clients should stay away from Europe for now because of the high volatility. And if, let's say, there's no negotiation tomorrow, Greece defaults and the market goes down for next few couple of days, probably will be a good time to get in, because like I mentioned, it will be a short-term thing only for the Europe, not for the Greece. On the economic side, um, just to show what's happening on the economic side of the Eurozone, the economy appears to be at an inflection point where the growth is expected to be 1.5%, which will be supported by the budgetary policy and the improvement in the manufacturing and other data within the specific member states, especially from Spain, Portugal, Italy, Germany as well. And the Eurozone's recovery should technically shift towards domestic consumption when the pickup in the recovery takes place, barring any economic shocks such as the Greek exiting, which might have a short-term effect, short-term negative effect. And growth in money supply is accelerating, which is a very important factor in Europe. The credit cycle, the loose credit cycle, is what they want. And that's happening due to their QE program, loose monetary policy, and the LTRO, the program. Few things that you might wanna keep monitoring. There's 4 more elections after the Greece one, which includes Spain, Portugal, Estonia, and Finland. And out of the next 4, Spain is the one which needs to be monitored closely. Why? Because the Podemos, they are leading, according to many surveys, their leading party is something what the Syriza in Greece is. They are anti-austerity party, and so a lot of investors, they're looking into Spain. Their election are due in December this year, and so during that time, it will be something to watch out for. Several headwinds have already turned to tailwinds and probably in future will continue, including the lagged effect of weakening euro, easing fiscal austerity, and more certainty in the banking sector. U.S. We still believe that U.S. economic-wise still remains quite healthy and is poised to grow and expected to grow by 2.2% this year. Non-farm, private, or manufacturing payrolls that had come out has all been better than expected, confirming a steady domestic labor market, which is a very good sign. The labor market has been positive for some time already, and this trend has continued, so it's a good sign. Construction industry uh, is trending upwards as well. That's one important sector within U.S. Retail sales is also improving after slumping Q1, so probably we can attribute it to the inclement weather. Uh, the right hand corner top chart, you might see this dark blue line, which is a quarter-on-quarter change. You would see that it has rebounded from the negative to positive. Confidence metrics, whether it's business or the individual, remains quite solid. It has been above 80 for I don't know for how many months already, and so anything above 80 and 90 is considered to be very good. And right now, I think it's above 90. Headline inflation remains at 0.3, which is not a good thing because they're targeting the 2%. But then we need to look into that the headline inflation is mostly affected by the low energy prices, and so if you look into the core inflation, that has remained to be around 1.6, 1.7%, which is a good sign that there is inflation, but of course due to low energy prices, their headline inflation has been low than their target. Our thesis that we have presented last time as well is that uh, the the U.S. economy is 70% of it is the consumer spending that comes through consumer spending, and What drives consumer spending are four things: the aggregate income, employment, consumer confidence, and the household debt. And all these indicators has been on the positive side. You look into the right-hand side chart, top one, which shows the personal consumption expenditure has been quite stable, and the quarter-on-quarter has kind of like moving upwards. Based on this thesis, so we recommend uh, sectors, consumer discretionary sector that includes recreational goods and airlines, and the consumer durables that includes furniture and auto companies that will benefit through the rise in income and through the rise in consumption. Moving on to the third economy, Japan. Japan, I will first show you what's happening around in terms of the economy, and then I'll talk about some more of the thematic views on Japan. So economic-wise, it is expected to grow by 1% this year. Business confidence has slightly recovered and shows some further improvement due to the implementation due to the corporate governance implementation of these laws and stuff. Machine orders, which is the leading indicator and the most important indicator when you're looking into Japan, has remained subdued, but will improve once the global economy picks up. Current account has remained positive, and that's because of the low oil prices, and so basically they were having deficit because they were importing a lot of oil, and then now the oil price is low, means they have turned into positive. Inflation remains low at 0.8%, still okay. Japanese yen is expected to depreciate further, by the end of this year, and that will help boost the corporate earnings as well. Now, if you look into all these data that I've talked about, most of this will suggest that the economy has remained weak, uh, but we still believe that it's a good time to be in the Japanese market. Reason for that is that we favor that the funds flowing into Japan is more important than the economy itself. Uh, Three important factors will be that BOJ ETF buying program, where they're buying $25 billion of ETF every year, has managed to keep up the market. Plus, the pension fund GPIF has doubled their asset allocation towards domestic equity, and now other pension funds are also other um, government pension funds are also following the same asset allocation, which means they will be doubling their asset allocation, and so these money will be flowing into the equity market. It has already been flowing actually. Foreign investors, another important driver. They constitute around like 60% of the total volume of Nikkei. And if you look into the right-hand chart, top one, uh, they have been positive for last couple of months already, and it's a very good sign that money has been flowing into Japan, and especially since things going on in Europe and there's this Greek volatility issue, people will be going on into more kind of like safer markets, which include Japan and US as well. Um, and foreign investors have been remain positive due to some corporate reforms as well, such as the like I mentioned, corporate governance, and then the lowering of corporate tax rate, and then negotiation on the Trans-Pacific Partnership, the TPP, that's the free trade agreement that is supposed to be the highlight for this year. Valuation-wise, still has remained below the historical average PE of 19.2, and this is for the MSCI Japan index, and that's due to the earnings growth. And we still believe that the corporate earnings that have already managed to beat the expectations for this quarter will continue to improve further. Uh, well, and okay, the last one, we got few recommendations in terms of unit trust and ETF that have exposure and invest into specific markets, and including US, Europe, Japan, China, Hong Kong, India, Indonesia, Thailand, Malaysia, and Singapore. Okay, with that, I will pass this to my colleague Richard, who will talk on this hospitality sector.
Morning, this is Richard speaking. 2 weeks ago, we published a report on the Singapore hospitality sector. So today I'm just going to walk you through what we did. We will take a look at some of the historical data and the change in the trends and give some explanations on why these are happening. First up is a snapshot. So this is a summary of what happened in the first quarter of this year. So first thing is visitor arrivals were subdued. There was a 6.1% decline, year-on-year decline for the quarter, and this was the worst decline ever since the global financial crisis. During the GFC, the worst year-on-year decline for the quarter was 13%. For hotel metrics, we have the average occupancy rate, average room rate, and RevPAR. So these three metrics were lower in the quarter as well, year on year. This was dampened by the absence of the biennial Singapore Air Show, and there was less demand for corporate bookings. And thirdly, we see that Chinese tourists are choosing Thailand, South Korea, Japan, and USA over Singapore for their holiday destinations. There are few factors that contributed to this. They are the easing of visa rules, strengthening of the Chinese yen, and geographical proximity to China. Lastly, the table here I've mentioned earlier. First line shows the visitor arrivals coming into Singapore. First quarter, there was a 6.1% decline, and then for the other hotel metrics, they also saw the year-on-year declines in the quarter, and RevPAR came down 7.2%. So this is the outlook that we have for the hospitality sector for Singapore. What we see is that we will still have a currency headwind due to the relatively strong Sing dollar compared to the other regional currencies like the ringgit and the rupiah, and this would in turn result in a deterrence that visitors from choosing Singapore as a holiday destination. Second point, STB had given their forecast. They had forecast visitor arrival growth to be 0 to 3% for 2015, but we don't think that we'll be able to meet the upper end of this target of 3%. If you look at the first quarter of this year, we already have a 6.1% decline, and as of the most recent updated data for up to April, the first 4 months, we already have 5.4% decline. We also see that average room rate will continue to face pressure, and consequently, this will affect the occupancy and the RevPAR. This is due to the weaker visitor arrivals as well as the upcoming supply of hotel rooms. But we do see a big trend that there will be a continued growth of outbound Chinese tourists. This is due to two major reasons. Longer re-entry terms for their visas that countries are offering now, and the strengthening of the Chinese yuan. The key risk to the hospitality sector now is the spread of MERS across the region. As of last Friday, there was already 31 fatalities reported in South Korea so far. Now, I'll show you some of the visitor arrival data coming into Singapore. So as I said earlier, for the first quarter of this year, visitor arrivals dipped 6.1% to 3.64 million. What you see here, the blue bars, are the visitor arrivals for each of the quarters, starting from first quarter of 2012 to the first quarter of 2015. The orange line is the year-on-year growth for each of the quarters, and you can see that already for 6 quarters since fourth quarter of 2013, we've been seeing flat to negative growth already. There has been no change in the top 5 largest group of visitors by nationality. So they are still coming from Indonesia, China, Malaysia, Australia, and India. And the visitors from these 5 countries account for more than 50% of all our visitor arrivals. While the top 5 countries have not changed, but market share among them has changed. What you see here, the blue bars are the percentage contribution in the first quarter of last year, and the orange bar shows the percentage contribution in the first quarter of this year. So this is comparing year-on-year change for the first quarter. You see that for Indonesia, China, Australia, the orange bar has gotten shorter. Malaysia is about flat, and there's been growth coming from India. Generally, what the trend we see is that where the Sing dollar has appreciated against the domicile country of the visitor, that has resulted in lower visitor arrivals, and conversely, where the Sing dollar has depreciated, then more visitors had come from those countries. But there is an exception for the Chinese tourist arrivals. For Chinese tourist arrivals, actually, Sing dollar had depreciated against the Chinese yuan, but there was actually negative growth for the Chinese visitors coming into Singapore. What we see is that Chinese tourists are actually favoring other destinations over Singapore, and there are 2 key contributing factors. The first one is the relaxation of visa rules. So for South Korea, Japan, and USA, they are now giving 5 years and 10 years multiple entry visas, which is up from their typical 1 to 3 years. And the other reason is that the Chinese yen has actually strengthened against the Thai baht, Korean won, and Japanese yen. And so this gave the Chinese tourists more bang for their buck in these 3 countries. So the Sing dollar was not the only currency to depreciate against the Chinese yen, but these 3 currencies as well. And South Korea and Japan, due to their closer proximity to China, it was more convenient for the Chinese tourists to head there, and also because of the shorter flight time. This slide shows how the Chinese yen had performed against some of their against the currencies of the travel destinations of where their tourists are going, and also it shows the growth of their outbound tourists in these different regions. Now we look at some trends for the Chinese outbound travel. There has been 18.8% CAGR since the year 2000, and as of 2014, there was 116 million outbound tourists. As of the first quarter of this year, there was a year-on-year growth of 8% as well, and there was 29.5 million outbound tourists compared to 27.1 million in the same quarter of the previous year. For the destinations where the tourists are heading, the lion's share comes from the Greater China. Greater China comprises Hong Kong, Macau, and Taiwan, and they accounted for 62% of all the outbound tourists in first quarter of this year. What you see here, so again, the blue bars are the first quarter of last year, while the orange bars are the first quarter of this year, and this is the percentage contribution to the different destinations of where the Chinese tourists are heading. So we've included the 3 Greater China locations as well as the top 5 locations, top 5 destinations outside of Greater China. So here you see there's Hong Kong, Macau, and Taiwan, and they have contributed a lower proportion of the tourist destinations this year compared to last year, whereas Thailand has shown phenomenal growth. There's growth in South Korea and Japan and USA. And as we know, Singapore, there's been less Chinese tourists coming to Singapore as well, and it's reflected in this chart here. While Greater China commands a lion's share of the majority of outbound Chinese tourists, but actually it is losing ground, and the Chinese tourists are actually traveling further afield outside of Greater China. So, as I mentioned earlier, the Chinese tourists outbound travel has grown 8.8% this year, but for the travel for outbound tourism within Greater China, it actually grew 4.6% only compared to the 8.8 for the total. And you can see that actually even for Macau, the year-on-year growth was a negative growth. Chinese tourists here, these are the top 5 destinations outside of Greater China where the Chinese tourists are going, and you can see the phenomenal growth for Thailand and Japan, and this double digit in the 30s for South Korea and USA, and Singapore was a negative 2.4% in the first quarter of this year. And um, on an aggregate level, these top 5 regions outside of Greater China, their visitor outbound tourism grew 54.6% in the first quarter of this year. Now we come closer back to home and we look at the Singapore tourism receipts. The tourism receipts TR had slowed to 0.4% year on year in 2014. You can see this chart here. The blue bars is the total tourism receipt for each year from 2011 to 2014, while the orange line corresponds to the vertical axis on the right and is the growth rate, and you can see that the growth has been slowing down to 0.4%. Then we zoom into one of the specific components of tourism receipts, which is shopping, coming from shopping, and you can see that in 2014, TR from shopping actually plunged 9.3%. So you can see that tourists are actually spending less on shopping when they come here. We now look at the first quarter statistics for hotels in Singapore, starting with the average occupancy rate. The average occupancy rate has been lower on a year-on-year and quarter-to-quarter basis, and is at 84% as of the first quarter of this year. This is where the occupancy rate was a year ago, and this is the near-term low, which was in the second quarter of last year at 83.5%. So as of the first quarter, we were actually 1.5 percentage point higher than the near-term low. Average room rate also has been declining. You can see this is where 0 is, and so it's been declining in the last 4 quarters or so, and it was down 5.5% year on year in the first quarter of this year. This lowering of the average room rate suggests that actually hoteliers had been lowering prices in order to cope with the lower visitor arrivals. And consequently, due to the lower occupancy rate and lower average room rate, RevPAR also suffered. RevPAR in the first quarter of this year was down 7.2% year on year, and this corresponds to the underlying factor of the 6.1% decline in visitor arrivals. So now we look at the headwinds for the sector. The overarching factor is that the relatively strong SGD will continue to deter visitors from coming to Singapore. This will weigh against visitor sentiment and drive them to other destinations, or it would actually promote their own domestic tourism within their own domicile country. Secondly, STB had already lowered their forecast for visitor arrivals this year to be 0 to 3%, and we think that it's unlikely to be able to meet the upper range of 3%. So we are seeing something between maybe 0 to 2% or worse. Um, Supply pipeline for new hotel rooms. So occupancy has already been down, visitor arrivals is down, and yet room supply is actually estimated to grow 4.8% to 6% over the next 3 years. At the end of last year, 2014, there was an estimated 57,000 rooms and an estimated of 3,100 additional rooms will come online in 2015 and another 3,900 in 2016. We also see that high-end retail segment driven by tourist consumption will remain challenging. This was from the 9% plunge in tourism receipt from shopping, and this was attributable to lower visitor arrivals and the strengthening of SGD. For tailwinds for the sector, Singapore is actually playing catch up in terms of the visa relaxation for Chinese visitors. Just now I mentioned that Japan, South Korea, and US had already relaxed their visa for Chinese visitors, and Singapore had also followed suit effective 1st of June this year. And they are now also granting 10 years re-entry visa. Changi Airport is offering reduction and rebates to the airlines and ground handlers in terms of passenger service charge, landing fees, and catering and ground handling. There's a $20 million marketing campaign by STB in conjunction with the SG50 Golden Jubilee. This was launched in May, and they are targeting these key markets. And lastly, there's also a partnership between Changi Airport and STB to invest 35 million in a $35 million marketing campaign, which would spread across 2 years, targeting these markets as well. Having said that, we wish to re-emphasize that the relatively stronger SGD is the biggest headwind for the sector, and no amount of marketing is going to improve things if the SGD remains strong. These are investment ideas for the hospitality sector. We think that pure play Singapore hospitality REITs will underperform their hospitality peers with geographically diversified portfolios. All other things equal, we still have to look deeper into exactly where the properties of where these properties are located, as well as they might be facing the same kind of headwinds. But at the moment, the two hospitality REITs that are listed here that are pure play Singapore are OUE Hospitality and Far East Hospitality. We also favor the retail REITs with a presence in heartland malls over those that are reliant on tourism receipts from shopping, like those on Orchard Road. So we currently have an accumulate rating on Fraser Centrepoint Trust. And next, to gain exposure to growth in outbound Chinese tourists, we are recommending our house coverage, which is covered by the Hong Kong office on this counter, Beijing Capital International Airport. Well, as you can see, the last close on last Friday was 9.24. They actually have a target price of 9.23. When we first published our report 2 weeks ago, the price was still 8.73, and this gain has already been realized already. Last point for the investment idea is we have a cautious outlook over the lackluster Singapore visitor arrivals, and this will strongly be undermined by the strong SGD, and that's why we also have a reduced rating on SATS. Okay, we have come to the end of the presentation, and welcome your questions. Okay, there's a question on SATS. To repeat the last point on SATS, give me a moment. Yeah, so we are cautious on the lackluster Singapore visitor arrivals, and this will be undermined by the strong SGD, and that's why we have a reduce on SATS. There's a question on there's a question regarding a comment by the president of the China Tourism Agency, where he said that he will allocate more funds to promote traveling within China. For the extent of our report, our focus is actually on Singapore. We are not so much looking at what China is doing, but we just included some of the data to give an explanation of why the Chinese tourists are not coming to Singapore, even though that the yuan had appreciated against the Sing dollar. So what we have explained is that it was due to two reasons of the easing visa rules and um, easing of visa rules and the stronger currency for their neighboring countries. As for the domestic tourism in China, actually, some of the data shows that the RevPAR is also going down for China.
Hi. There's this question on US futures already seeing a 1.5% correction when it opened this morning. Will we see S&P 500 correcting to below 2000 level? Uh, it's hard to say like how much this. I wouldn't call this as l- to be like a technical correction or anything. It's more of like volatility, and so right now the futures are down 1.5%. If nothing happens and the cash market opens tonight, probably we'll see the same thing on the cash market side as well. Uh, the level whether it goes below 2000 will be determining what happens in the next few days, and we believe that the volatility will be high. Uh, Tomorrow we would know that whether the Greece defaults or not. Most likely, probably might default because they don't have any money, and all the emergency loan and the debt bailout extension has already been rejected. So that might be the case. Uh, so you would see a lot of volatility, but I won't be able to comment whether it will go below 2000. I mean, that will depend on the technical as well. There's few questions on China and in Hang Seng. Unfortunately, the analyst that covers this market, she is on holiday. There's this question that what do you think the impact on Malaysian and Singapore shares if and when Greece exit Eurozone? Well, Greece exiting Eurozone is I mean, it will take few months to for that to happen. Right now, the issue is the Greece defaulting that might lead to Greece exiting the Eurozone. And like I have mentioned in the slides that in that situation, all the global market will be affected. So whether it's Malaysia, Singapore, Japan, US, all these market will be affected short term only. So that might give investors an opportunity to get in and maybe to get a buying opportunity. Brexit is a known fact and not as something out of blue as such. Is this sell down as merry collection to collect stocks of good fundamental on the cheap? Um, Probably, yeah. I mean, if it does really happen, because right now we are only what we are seeing is the is very small volatility, and that will continue. But if Greece gets out, you will probably see a correction in the Europe side, and then that might give an opportunity to buy good, fundamentally good in cheap stocks. Yeah, so that's true.
Hi, there's a question on whether the hospitality research shows that Chinese tourists are increasingly traveling within mainland China itself. As I said earlier, actually our focus is on the Singapore hospitality. So we were looking at China only from the point of view of why is it the Chinese are not coming to Singapore even though the yen had appreciated against the Sing dollar. So we are not looking at what the Chinese tourists are doing within China.
There's a question on whether where is the major support level you see for S&P 500. Unfortunately, the technical analyst Kenneth he's on leave. He will be back I think on Wednesday. So if you have any questions, you can email it to him directly. Um, Kenneth Ko is the name who does all the technical analysis. Okay, if no more questions, we would like to end this presentation here. Thanks for attending, and those who have missed. Thanks for attending this webinar. We would like to end this here with no further questions. Uh, those who have missed this webinar can actually log on to the uniphilip.com, and under education programs, there's this Philip Securities Research webinar where they can go and can have a look at this entire webinar all over again.